welcome to everyone. Got a big group today. We'll give us a couple minutes. I've got noon exactly Eastern time, so we'll start here in about 2 minutes. And those of you who have attended before, I always do the anxiety-producing question of, I hope you can see Rebecca's screen and hear me. So if you wouldn't mind just raising your hands that if you can see the screen and hear us. Excellent, excellent. All right, thank you very much. Perfect. We've all had the fun of making incredible points in poignant ways with lots of humor, and nobody hears us because it's muted or other tech difficulties. So definitely don't want to have that happen for Rebecca and Mark. So, all right, wait another about 30 seconds and we'll get started. All right, I'm going to go ahead and get started. Make sure everybody stay on time here today. So I am Brian Klontz, founder and president of Charitable Solutions. We have Rebecca Dupre with us today, who's been with us. I don't even know how long, Rebecca. I think it's been 4 years. It's going to be 3 or 4 years, something like that. So it's been a while. Known her well over 20 years. And she leads our real estate area more specifically. So subject matter expert on our team for all things real estate and leads sort of our group there. And then I was presenting out in Omaha about 2 weeks ago-ish, I think, and saw a great friend. I won't say old friend, I'll just say a great friend, Mark Weber, who's done incredible work around the CAP program more specifically, but working with professional advisors, encouraging them to sort of raise the right question, right time to encourage their clients to consider philanthropy. And not only are they considering it, they are implementing it. So I asked Mark to be a guest presenter with Rebecca. And so pleased that both will be taking us through our topic today, which is maximizing professional advisor relationships, fundraiser, friend, or foe. You've got their contact information there. For some quick housekeeping notes, again, we do not send out slides after. However, we will send out a full recorded link. We have, I don't know whether this is our 50th one, but it's got to be real close in terms of past webinars, all available, all free, anytime you want. We've been able to port everything over to a YouTube platform for more memory capacity. And so bottom line is all this will be available that you can watch multiple times at your leisure should you wish. I would ask too that if you do not put anything, it's not horrible, but anything in the chat, we probably should just disable the chat, but it's a little difficult for us to scrape it post presentation. So if you can include any questions and answers, which we very much encourage, I will sort of call those out as appropriate to Rebecca or Mark, or answer some of those too. So in the Q&A section at the bottom. So we'll take about 5 minutes. I'll go through the weird things that we do at Charitable Solutions. So formed the firm in 2021. Rebecca, if you just maybe advance the slide, we'll go to the next little part there. And our mission since day one and continues to current, and that is to help make charitable gifts happen that otherwise wouldn't. And basically being the lubricant or the bridge intermediary to manage risk through aggregation to make gifts happen. And to do that really in 6 ways. I'll go sort of top right over. So emergency assistance fund administration audits. So we do a lot of this relative to direct work for disaster relief and personal hardship grants. So I created the Emergency Assistance Foundation in 2011. We need to update that. There are about 400 companies that we currently manage their funds, primarily sort of Fortune 500-ish. Average employee group is about 20,000. And we do that globally. And so we manage their funds so that they can make donations to that fund as a public charity through vendors, through the company itself, through payroll deduction, so that when their own employees or whoever the member of their charitable class is impacted by either a personal hardship or a disaster, we are then able as an independent charity to make grants back to that individual fully tax-free. And so that is that structure. Bottom right, do maybe 60 to 80 days out a year, getting to see people like Mark and other friends around the country around professional advisor, CE, donor, board, staff training. So doing obviously what we do today as well, but many people on the team do these. I know Rebecca speaks a lot. Paul Casperson, I spoke with this morning, is going to, I think, to 3 places next week. So do a lot of CE type education all around the charitable space. Bottom middle are charitable appraisals. So our tagline, which I think works well, but we say if you can give it to charity, we can appraise it. So we've got a team of 5 people, each with different expertise areas. So I do, for example, the life insurance and crypto appraisals. We have 2 people doing all business appraisals, 1 person doing precious metals, and then 1 person doing all tangible property. So we have a whole team. Again, if it's a lifetime gift, life income gift, or estate gift, to the extent you need a qualified appraiser to complete a qualified appraisal, that's what that group does. And then we'll enter the land of gift annuities. So this is probably 25, 30% of our aggregate firm work. Do 2 different things. One is their top middle, where we have an actuary on staff, have since day 1, where we do stress testing and actuarial analysis of gift annuity pools, primarily larger pools, usually 5 million plus, but basically try to determine where risk is, where it isn't, how to mitigate that risk, and ideally trying to, of course, maximize the residual values. Within that, in some cases, reinsurance is appropriate, either partial or full. We do design and placement of reinsurance for charities. That's all we've ever done in that space, going on about 25 years in that space now, to the extent that that comes up, in particular with very large concentrated risks or very large gift annuities coming in as new gifts, which appropriately, frankly, can concern charities, all things being equal. And then for those charities that say, you know, we don't want to do the gift annuities ourselves at all, would like to outsource that entire piece, then we have the National Gift Annuity Foundation. You can see there we are issuing in all 50 states. We are so close to 1,000. We had a full firm meeting yesterday, and I think we're at 995. So I cannot wait to be able to take the 900 plus contracts and make it 1,000. But the point is that's 1,000 different situations where the charity was not willing or able to issue the gift annuity themselves because they weren't registered in New York or California or Hawaii, et cetera. Or they're not doing any kind of gift annuities and they want to basically sunset their program but not say no to new ones. Maybe they didn't start a program. Maybe they want to do one for Bitcoin or real estate. We're doing a lot with real estate. Paul leads that particular area. And the bottom line is if you have a good donor with a good asset wanting to do good things with gift annuities, we can take a look at that. We've done some for retained life estate gift annuities, kind of that charitable reverse mortgage model. So the point is that we exist as an intermediary where 100% of the residuum is then granted back to the charity the donor was trying to give it to in the first place, including multiple charities. So it doesn't just have to be one. We can bifurcate the gift on the back end. And we do really the same thing from an outsource model for non-cash assets. So again, Rebecca helps us in a huge way with our real estate gifts, but through our Decami Foundation, we can receive through a donor advised fund gifts that other charities were not, again, willing, able, ready to receive. And instead of saying no, they can refer that over to us. We do due diligence. We're on chain of title, do all compliance. We call that the sausage making function. So all of the sausage stuff until it's liquid. And then when it's liquid, we don't manage anything when it's liquid. So it's got to leave us, just like the gift annuities. And then the full residuum, or for whatever's left over, net of our fee, which averages about 1.3, 1.4% or so, is then granted back to the same charity or charities, including other donor advised funds that the donor was trying to make the gift to. So you can see there, we've done over $4 billion in non-cash assets alone. That's not counting gift annuities. That's also not counting any of our charitable remainder trust work. So we've now in the last year and a half served as trustee for CRTs, whether it's non-cash or liquid. But if the donor's looking for a trustee, we can service that trustee during that period, either long-term or at least until it's liquid, and then we can resign to the successor trustee. So all of this is about risk management through aggregation and structure with incredible staff like Rebecca and 25 others just working on these types of gifts, helping them happen that otherwise wouldn't. Quickly around the non-cash, just on the next slide, just to sort of break this out a bit. So these are just not CRTs or CGAs, just outright current gifts You can see there what we completed last year was about 161. We're at 116 year to date, so we're running about 30% ahead of where we were last year. So an incredibly busy summer. Key call out points, the average gift that we completed was $6.8 million. That's average. Bit higher than most. Median's probably closer to 3.5 million or so. Not small is the point. Also, very important to call out, we're doing actually more, we being Rebecca, more real estate than any other charity nationally, which is kind of weird because it's 41. But we'd also include a lot of the LLCs actually hold real estate. So really, it's a real estate gift if you sort of blob it over. But doing a lot of that, but our real core are private business interests. 85 to 90% every single year consistently have been private business interests. And you can see almost 1 billion just in that activity. The big point here in the parentheses, 100% of these gifts were declined. That's the only reason that we're getting a referral. So we get about 8 to 10 referrals a day, roughly 1 completes per day. But the one is big. Once we then sell, we're doing all the stuff. Again, on average, 1.2, 1.4%-ish is our fee that's held back at the time of sale. So no, the donor's not paying that directly. The charity's not paying that. We have no contracts with any charity. Then the donor's recommending then that final net grant that goes out 30 days later. So we're just a donor advised fund pass through for these types of gifts. So that's really it. You have any kind of cases like this is what we exist to do. And let me now pass it over to Rebecca to talk about our agenda and professional advisors, fundraising, friend or foe. So we'll be able to go through that. So Rebecca, take it away.
Great. Thanks so much. Really excited to do this today. Thanks to Brian for doing it, for Mark for being a co-presenter, and for all of you for being here. So we're going to just try to cover a few things as quickly as possible. There's a lot more we could say. I think after Mark and I spoke a couple of times, we realized there's a lot to say here, but we're going to try to cover the high level stuff and then give you some advice as to where to get more information at the end. So we're going to talk about who the professional advisors are, why it's critical to be working with these folks, some of the trends that we're seeing in philanthropy, and then we'll talk a little bit about best practices and ways to work with professional advisors. And as Brian mentioned, I think the Q&A is where you can put your questions. So we wanted to first discuss who the professional advisors are, because I think it's important to understand who some of these folks are and who who you should be looking for if you're either trying to expand your program or build a new program around the cultivation of these folks. I tried to put it this way because I wanted it to be somewhat visually understood that there's a lot of different people that are potentially swirling around who you might consider a high net worth donor, or or just a ultra high net worth donor, or however you're categorizing your donors and your prospects. So some of the folks that I think are important to understand are attorneys, and I suppose I'm starting with them because I am a lawyer, so I have a particular bias towards attorneys. But I've also been a fundraiser. I've done both jobs, so I think it presents a bit of a unique perspective, and Mark has a bit of a unique perspective as well, having his JD, but also being in the fundraising space. So lawyers are a great resource for cultivation. I think one thing that I wanted to point out that I think sometimes people get stuck on with lawyers is they think that they should just be going after the estate planning attorneys, which I am one. But I encourage people who are asking me questions about this topic to also think about other types of lawyers. So real estate lawyers, business planning lawyers, tax attorneys, folks like that, I think sometimes don't get on the radar of fundraisers. And they are also talking with high net worth donors about their assets. So that's what you're trying to think about, is who's talking to these folks about their assets. So another great person, I feel like the accountants are kind of like the gold people in this whole thing, because they meet with their clients at least once a year, right, to do their taxes, and sometimes more if they have other things going on. and they know a lot about their financial picture. So they have the ability to really advise them on the way that the gift is going to impact their taxes, their cash flow, all the things that a high net worth donor or any donor would be concerned about when thinking about making a gift to charity, whether it's cash or non-cash. They're hard sometimes to pin down because there's always, the joke, I guess, is that there's always a 15th of every month. So they're always on some kind of deadline, right? It's not just April 15th, but it's October. And then if they do business planning, you're talking about September. So you have to be flexible with their schedules, but they're a great resource. And I think the other top resource is the financial planners. I think they're great too because they do meet with their clients regularly. They're generally at least annually or sometimes quarterly talking to their folks there. Um, they're probably a little bit more of the salesy side of the coin here. I'm not saying that no financial planners are transactional, but they have that that desire to cultivate their clients in a way that can make them a great resource. I think as you're trying to think about who to cultivate from the philanthropy side. And this is nothing against the other three disciplines that I've put here: brokers, bankers and trustees, and life insurance agents. But I would say that unless they have a particular affinity for your charity, or they seem really engaged with the idea of philanthropy, I would say the top three in my mind are attorneys, accountants, and financial planners. And Mark, I don't know if you have a different kind of take on this.
No, I would agree with Rebecca. The accountants meet with their clients annually, and people think, and so if a nonprofit's looking for a current gift of cash or an asset in their normal fundraising, accountants are going to be the ones no donor wants to do something stupid where they make a gift and they lost the deductions. They're always going to check their accountant first. But if you're looking for a bequest, then that's the attorney. And many attorneys, frankly, don't meet with their clients more than once every 4 or 5 years until they update their wills. And I think people don't realize that. They think they're always talking to the attorney. They're usually not, actually. And as far as like life insurance agents and brokers, those tend to be a middleman where an attorney or accountant has brought them in. They don't normally have as direct relationship, although some of the wealth planners have very close relationships with their clients. So it really kind of depends. What I was going to say is I find it's always that like 80-20 rule as we apply to so many other parts of our life. It's the same thing with high net worth donors. They're going to use 80% of the donors are going to use probably 20% of the advisors. High net worth people tend to go to the same clubs. They are socialized. They talk to each other. They refer each other around. So I'm not, again, there's always exceptions to that, but at least in our community, the top estate planning attorneys, there's probably 6 to 10 of them that handle 90% of the wealthy people in our city. And same with accountants. There's several major firms that handle some of the very top clients. So that doesn't mean you shouldn't reach out to everyone, but if I was picking where I was going to spend my time, I would try to identify those who work regularly with the high net worth clients.
Yeah, sorry, go ahead.
I was just going to jump in a couple quick comments. So one, I do think it's important you did a great job sort of laying out the different types of advisors. I do think it's particularly important about how they get paid too. And so within the advisor community, we all know how we get paid. So I was an advisor for a while, and fundraising side, and then advisor again. But just as Rebecca said, generally, not always, but generally, accountants, attorneys are paid in literally 6-minute increments. So they're billing at 1/10 of an hour, of their time, and they're selling time. And if you talk about sort of insurance, financial planners, generally, they are more, as Rebecca said, transactional, and they're paid through either transactions or assets under management, those types of things. So it's a very very different mindset about how then they would interact with fundraisers, where I've almost seen viscerally, like if there was a botanical garden, they said, oh, we'd like to get a professional advisor committee together, but we can't ever get the attorneys and accountants to come out for the advisory committee. Like, yeah, because they're losing 1/10 of an hour billable increments as they're sitting there, in the garden, which is great, and they're getting lunch, which is great, but that's their time, versus they said, but all the financial advisors want to come, like, right, because they want to network, but they were not making those connections. So I just think it's important to understand that mindset, number one. Number two, this is evolving, and I'd really defer in a big way to Mark. So Mark, not to sort of build him up too much, but work sort of the highest of the highest of the highest net worth sort of financial advisory tier. And what at least we're seeing in terms of our non-cash transactions is roughly 15 to 20% of these are now being facilitated by single or multi-family offices. So I think it's important to understand that at the very high level, not sort of traditional high net worth level, but the ultra high net worth level, there is a massive, massive trend toward family office support, which is code for all the people on this slide within one particular group, only working with this one family or with multiple families. So it's just important to say it used to be they were more, each person would sort of cobble together their team. And the family office concept generally is we've cobbled together your team, you attach to us, you get the whole team. And that is seeming to be very, very attractive sort of within the marketplace. So I'd like maybe you guys to talk about that. And then I definitely want to talk about accountants a little bit more because a great question came up around accountants specifically. But any comments, I guess, on that? Or I guess, are you seeing that, Mark, too, in terms of the family
The family office
office?
thing is a huge trend. I mean, when I was at Silicon Valley Community Foundation, and this was almost, I don't know, this is like 2014, that was really when I first got exposed to that, and I've only seen it grow since then. And it was really the bigger institutions that were doing it, and now it's become the quote unquote small, like the more boutique places are now also, they're hiring their own lawyers, their own accountants, and just for that purpose, because they want to keep everything in-house.
Right. Well, one thing too on the Q&A side, it's got I found it very difficult to gain traction with the tax planning accountant group. Discuss this with peers who feel the same. They seem positioned well to be great partners, but often seem to be reactive compared to proactive. And so I'll mention this briefly. I'd love to hear your comments on this too, Rebecca, on the fundraising side in particular. But when I was in Atlanta at the Community Foundation, we would track all professional advisor referrals. About 90% of all of our donors came to us as referrals from their professional advisors, very similar to that as Silicon Valley, frankly. We got almost zero from CPAs. And when I mean zero, we get about 500 referrals a year, maybe 8 from CPAs. We always try to get to double digits. That'd be like a great CPA year. And it makes no sense to anybody. And the only thing that I can say from my experience, not being a CPA, and there are some on the call, I get it, I say all this with love, that CPAs seem like when they come out of the womb, they are built to look in the rear view mirror. I mean, they're just hardwired to look at stuff that's already happened. And to look like in front of the hood, I don't know why it is not calibrated to think that way. So they could document everything on what I would call a 1040 type CPA. The documentation, stellar, but the fact they've been giving $100,000 a year in cash to their favorite charity, and they've got a huge amount of long-term capital gain publicly traded stock, it is unbelievably rare for that CPA to make that as a tax planning recommendation from my experience. There are people who have CPAs who aren't CPAs. They have that, but they are family office, wealth planners, AUM models. They've got a great tax background. They're totally different. They're looking ahead in a big way. So our 8 referrals a year almost always came from more financial planner CPAs than traditional tax return CPAs. But I think that's a huge disconnect in the fundraising community because they think, oh, I get to a CPA, they're seeing their client every year, they're talking about taxes, that's perfect. We did it, I'll be real blunt, and this is recorded, whatever. We marketed to CPAs like crazy for damage control because everybody trusts their CPA, I say with love, way too much. And if that CPA, I'll say it's an old, white guy, leans back in the chair, like, I've lived, practiced for 32 years. I've never heard of this group. You're dead. Like you're dead. It's going nowhere else. All they have to say is, oh, I've heard of them. I think they're okay. Good. Don't say anything else. Now let's have the relationship. I hate to be bad about it, but it's a very weird dynamic of the relationship between the client and the CPA. And in my view, the lack of tax planning, especially charitable tax planning. And they also, I'll say one more thing on my soapbox. I have call after call after call where they say, oh, you don't want to give that much because you're going to exceed your AGI limitation. Donors like, I'm charitable. I want to do that. They cannot calibrate the logic that if you're giving something and not getting some benefit for it, that they cannot figure out why. I'm speaking for all CPAs here, which is great. Why you would ever make a contribution that you're not getting some direct benefit from. Because again, that's how they're built, which is okay, but I think it's just important as the fundraising community and other advisors sort of understand that concept. So I've droned on. I'll pitch it back over to you guys.
Yeah, Mark, I don't know if you have anything you wanted to add to that. I think Brian summed it up pretty well.
I was laughing when he was talking. When you think what accountants do, they are always looking backwards because they're looking at what happened in the year before during their tax return. That's what they're trained to do. I'm going to wait to talk about this a little bit further or later, but one of the things I think, because historically, clients tend to use advisors in silos. They want an estate plan, they call their attorney. They want a tax return, they call their accountant. They want a loan, they call their broker. They want to invest, they talk to their wealth manager. And one of the things we have been doing in Omaha is getting advisors to meet as teams with their clients. And the difference there, when you have an accountant in the room and the client is talking about the future, what they want to do, then they bring their tax knowledge and are invaluable to the conversation. But it's not natural for them to look forward. I do agree with that. But given the opportunity, they're a very valuable part of the team. So, go ahead, Rebecca.
I think that's true. I mean, I think that both of those statements are true. So when you started talking, it reminded me that sort of led into this next slide, which is why I advanced it, because I think it leads into why it's critical to work with professional advisors in the fundraising space. Because, as Mark just said, and we were talking about, most high net worth donors have multiple people that they're working with. And as an advisor, I will say to you that sometimes it's frustrating for me when I'm trying to work with somebody on their estate plan, and it's hard for me to get access to their CPA or if they're working with like a business planner type person. It's easier for me to do my job as an estate planner when I know everybody's perspective on what they're trying to accomplish. That's the best outcome. So I do try to work in that space that way. And as a fundraiser, I found it to be somewhat similar. Like, it's an opportunity sometimes for you because as a fundraiser, particularly, you have a skill set that is, tends towards bringing people together, right? So I would say use that skill set to try to, encourage the donor to bring their team together as you're trying to talk about a gift, particularly a gift that's going to be substantial or of a complex asset, because you're going to really need those people to weigh in on the transaction, because you're not, one thing that even when I work at Charitable Solutions, even though I'm a lawyer, I say to the people on the calls all the time, I'm not your lawyer. I'm not a tax attorney. I don't practice law for you. You need to talk to your own advisors. And that should be the statement that you're also making as a fundraiser, in my opinion. And, these folks are not really going to make moves without their advisors on board. But I would also, kind of getting back to what we were talking about, I wouldn't assume that advisors know anything about philanthropy. So I will say that when I was a new-ish lawyer, probably like 5 or 6 years out, I had a conversation with someone at the Rhode Island Foundation who was the fundraiser trying to meet with me to talk about, working together. And I wasn't in a position to refer anybody at that point in my career, but she still took the time to talk to me. And that was literally the first time I had ever heard of a charitable gift annuity. So nobody is really, like, a lot of advisors aren't really in this space. And so to Brian's point about like that, you know, somebody leaning back and saying, I don't know anything about that. I think sometimes we, as fundraisers, assume that advisors know about philanthropy when they really don't. And if they don't know about it, they're less likely to talk to their clients about it because they don't, you know, and I'm going to say this as a lawyer, but like, we don't want to look like we don't know what we're doing. So we talk about the things that we know. So I would say that, you know, and we're going to talk about cultivation, but I think that kind of leads into a conversation about ways to cultivate and ways to be a resource to the advisor, as well as the advisor also being a resource to you.
Rebecca, I was going to interject for just a minute. Keep in mind that when Brian said that the advisor doesn't understand, particularly accountant, the answer, he doesn't understand, the always answer is no. But the advisor, particularly accountant, has information you don't have. You may propose a wonderful gift that the donor is very interested in doing. But what the accountant knows is that you've already exceeded the amount of deduction. You can't use it this year. But as we are training nonprofits in our city, which I'll talk about in a little bit here, we suggest to them to ask the donor. Now, you have to have a good relationship, and the gift's got to be a long way down in the cultivation phase. But to say, would you mind if I ran this by your accountant? If I shared the information with your attorney that we're talking about? And that gives the advisor an opportunity to look at it and study it before they opine on it, as opposed to catching them cold. And if they don't understand, they're gonna say no. So anyway, that's one of the advantages of working with teams and cooperating and coordinating with other advisors. But go ahead, Rebecca.
Yeah, so I think just the other kind of points on this before we move on to the next is that, you know, as Mark was saying, like there's a few people working with, you know, several people. I think Brian mentioned that too. So it's sometimes it's beneficial to your organization to begin the cultivation of advisors, or, you know, enhance it if you already have a program that you've started. Because you're going to reach more people with the one person that you're cultivating. You're going to reach all potentially of their clients. So that's kind of the thought process, I think, behind this. And then I wouldn't discount the fact that sometimes you have to start with like just having them as thought partners and board members before you're really going to get in the door with their clients. And again, we'll talk more about this when we talk about the cultivation piece. So some of the trends, I think, on this slide are not particularly like revolutionary here, but I just wanted to point them out. So we're all, you know, hearing about this, the large wealth transfer and the fact that high net worth donors are potentially going to be able to give away more to charity. But again, I think it's going to be part and parcel with the advisor understanding better how they can utilize the charity or the charitable deduction or whatever the framing that you want to put in order to benefit their client. It, you know, it makes them look good. It makes the donor happy. You know, everybody wins, but they need some advice about how that works. And then, you know, we've all been to, or probably many of us have been to those, I think it's, what is it, Bank of America or whatever, that those groups that do the like reporting out on the trends in philanthropy and seeing the slides on how donors are saying that they're bringing up the conversation and not their advisors. And again, I think it really goes back to the fact that the advisors don't necessarily understand how it works. And I'm not saying that in a disparaging way, but you know, there's just so many things that an advisor is trying to do at one time for any of their clients, and it's hard to focus on another thing. So again, we're going to talk more about this and how to bridge that gap in a few minutes, but I just think that, you know, it's an opportunity for fundraisers to provide education and provide a means for the advisor to then be able to bring up the conversation with their clients, and make it a little bit more, you know, even from that standpoint. But I wanted Mark to talk a little bit about the CAP study group that he works with. I think that's a really interesting trend. At least it was to me when he told me about it. So I think everyone here will find it interesting too.
Yeah, my background is in the financial services business, particularly in the very high-end life insurance business. And I'm an attorney by background. So I was oftentimes asked by clients, when they went to see their their estate planning attorney to do their planning, they would say, my attorney speaks in Greek. I never understand the legalese. Would you come and just sit with me and kind of help interpret what they say? And so I probably sat through 150 to 200 of these meetings over my career. And I saw what happened in the attorney's office with clients and how the charitable question was asked. And I knew that there was opportunities being missed when advisors could talk about charitable gift. But I realized that Rebecca is saying, we're not taught this in law school or business school. We're not taught about philanthropy. The only thing we are ever taught about is the tax implications of certain techniques. So I don't go into this whole story, but I was inspired by Warren Buffett at a meeting one day, and he challenged, how could we make our communities more generous? And so 14 years ago that happened. And in my career, we all have some very wealthy people in our communities, and we know their names, and they're your biggest donors. But in my business, and the same with other financial advisors, they realize the real wealth, 75% of wealth in America is held by baby boomers. And I don't know the breakdown of this, but the vast, vast majority is going to be in privately held businesses and real estate. And many of these people are the millionaires next door. No one knows who they are. And those are the people, we had last week, somebody made a $9 million gift to a law school who the biggest gift he ever made in his lifetime was $500. And it's kind of a, nonprofits love to have it happen, but they really feel bad they didn't know about it and couldn't nurture the donor and say thank you. But the advisors know who these people are because they have to deal with them in their accounting and their legal work. So I thought if I could get to those advisors and train them about philanthropy, we could make Omaha a more generous community. So I started this. There is a designation you get from the American College, which is in Philadelphia, and it's 9 graduate hours. And this designation is called Chartered Advisor in Philanthropy. And all of it's online through lectures and reading materials through the American College. What I did was set up a study group in our community, and it was by invitation only. I invited 3 of the top estate planning attorneys, 3 of the top tax accountants, 3 financial advisors, and 3 nonprofits, plus a member of the Omaha Community Foundation. So we had 13 people. And we studied this material together and talked about interdisciplinary. And I didn't really have any idea where this was going to go. But 1 year led to 2 years, and we're just now finishing up our 13th year. We now have 150 advisors have gone through this program in Omaha. We've created this atmosphere of cooperation. Instead of working in silos, advisors are working in teams. Instead of competing with each other, they're cooperating with each other. The Community Foundation tracks the results from their referrals, and I may have these wrong, but it's something like this. I think about 80% of the new accounts open in the Omaha Community Foundation, who's been my partner throughout this whole thing, I think about 80% come from advisor referral. Of that 80%, about 70% are from CAP graduates. When they measure the difference between a referral from a CAP graduate advisor and a non-CAP advisor, the CAP advisors on average refer over twice as many donors to the Community Foundation, and the average size gift, I think, is 2.5 times is great from somebody who was not a CAP graduate. And so what happened is what Rebecca has referred to a couple of times, advisors oftentimes don't know about philanthropy. And so in this material, in this course, this designation, they learn about the philanthropic sector and they're comfortable with it. And so now when somebody says, I want to make this gift, the accountant doesn't say, oh, you can't do it, you can't take a deduction this year. Now what our accountants will say, that's interesting. Thank you for your generosity. It looks like you can only deduct this amount this year, but let's look at how we can carry this forward for the next 3 years. Or let's restructure the gift since you want to do it. How can we get there? And so that's what's been happening. After 10 years, we did a survey among the advisors. We asked them, and there's more into this, but basically on a conservative basis, since you took the CAP training, what is your best estimate of how many charitable gifts, the amount of the charitable gifts that your clients have made. And the number came back and floored all of us. It was $9.3 billion. $9.3 billion. Now, we didn't track where they're giving it to. We can only assume, since these were Omaha advisors, they were dealing with Omaha clients, and probably most of the money is going to come back to Omaha. So the impact of this is now, I think, I don't work, I'm just a volunteer, but I think the American College has maybe close to 24 community foundations offering these study group programs. I know Boston and Philadelphia and Orlando and Tacoma and Cincinnati and Madison. Anyway, there's a number of cities that have put this together and are successfully building these in their communities. So whether you use this model or another model, it clearly shows the impact of including advisors and educating them rather than just getting to know them, providing them education. So anyway, it's been going great in Omaha, and we're going to continue to build this. We now have a waiting list to get in to the program, and we continue it as a invitation only, because we want the very best advisors, and we want to cross pollinate among the different advisor groups. So there you go, Rebecca. That's a quick summary of what we've been doing.
Yeah, no, I think that's great. And it's all in person that you're doing, but I'm sure that some of these other folks have different hybrid models and things like that. So it's worth checking out if you're looking for something like this. So I think this is a part where I think, we can kind of bring some of the things that we've been talking about together. Mark and I, like I said, had a great conversation leading up to this presentation. And I think one of the things, I've said multiple times is the concept of cultivating advisors, which I think really is the thing I want to focus on and kind of brings the rest of these little boxes together. There's lots of ways to do it. So I have, as a fundraiser at the Rhode Island Foundation, I actually was the lead of what we called the Professional Advisor Committee. So we would bring together attorneys, financial planners, accountants, and other advisor type folks who were working in philanthropy or wanted to get more information about how best to work with the community foundation in Rhode Island. So I did that early in my tenure as a fundraiser. And then ironically, now I'm on the Professional Advisor Committee as a member. So, because I moved back to Rhode Island and live here again. So it's interesting again to kind of see both sides of it. And one thing that comes up, at least in my opinion, a lot is this kind of idea of making it easy for the advisor. So I think it's really important to understand that, not that fundraisers aren't busy. That's not what I'm trying to say with this statement, but advisors are busy and they want to help. So it's very important to be able to give them the information in a way that they can then turn around and reuse it or share it. And that's kind of goes with the make it easy and the treating them like donors and the advertising it piece. It kind of works in with all of those pieces, I think, because, for example, what I would say is, if you need to be able to tell your story in a way that is meaningful, not just to donors and prospective donors, but also to the advisors, and then allow them to be able to share that information out. For example, sending them links that they can share on their websites or share in their newsletters or share in their social media, because again, it makes them look good. It makes your message get out to their clients, and it, helps everybody in this ecosystem. Because advisors do want to do good things. They just don't always have time to do them. So they want to participate in the community. It makes them look good. And they want their donors, their clients, to be donors to your organization, because again, it makes their clients happy. So I would say that that's one kind of maybe basic thing, but something I just find that isn't always prevalent in some of the, the groups that I'm working with. And then I would also say that Mark and I talked about this a little bit. I think that if you're starting out a program and like you haven't really done anything, when you're thinking about who to cultivate, you want to go for folks who are a little bit longer in their career, have maybe they're the ones actually speaking with the high net worth or the, the donors that you're trying to get in front of, whether it's an attorney, a CPA, whoever it is that you're talking to. But I think if you have a program established, one thing that I wouldn't necessarily sleep on is the concept of of the newer advisor, somebody who's maybe not brand new, like year 1, 2, or 3, but has been in a place for a bit of time, but is still relatively new, maybe isn't necessarily working directly with those types of folks, but is part of a team with the more senior person. Again, this is anecdotal, but I was part of a group at the Rhode Island Foundation that cultivated the younger or more, newer, whatever word you want to use that doesn't sound pejorative, advisor. And ironically enough, I'm now on the pack with many of those people that I cultivated back, 15 years ago. So I think it works, because at some point, the folks who have been doing it longer are going to leave, and the people that are coming up behind them, if you have been working with them throughout their career and you've shown an interest and you've taken them, provided them with some resources and given them some education, they're going to remember you for doing that. And they're more likely, I think, to want to work with you if they have a donor who's interested in, whatever it is that your particular group is doing. So I want to let Mark speak about some of his thoughts on this too.
Yeah, on the professional advisor council, which you're talking about, Rebecca, I think that's invaluable to have for a nonprofit. I would encourage you to, as a champion, whether it's your chairperson, is probably be an attorney or an accountant. Let me explain why. We had I helped start one in Omaha. They're sensitive to timing, and it doesn't mean they're not going to sit there and have a conversation with you. Like Rebecca is saying, they're billing in increments of time, and their time, whatever they're charging, $200 or $400 or $500 an hour, and they're not wanting to sit there and talk about the weather and what type of donuts you have and start 15 minutes late. If you're going to invite them, have something to say, have an agenda, have it sent to them in advance, let them know what they're going to talk about, ask them to donate something they can bring to the table, like review your marketing material. What are the tax advantages type of gift? They should be there because they bring value. And so just be cognizant of that. And that's why I suggest having an advisor who charges by the hour instrumental in leading it, because they'll be cognizant of that. One thing I was going to say is I've heard this over the years from nonprofits on occasion, usually the newer nonprofits, that they think they can approach an attorney or an accountant, and they think advisor or clients ask them, hey, I have money to give away. Who should I give it to? I've never seen that happen in my career. Rebecca, maybe you have once or twice, but I've never seen it. People, they don't ask advisors who to give it to. They ask what's the most tax advantage way to get it? Can I get a maximum deduction for this? How to do it, not who to give it to. So I think you're barking up the wrong tree if you think that's what they're going to provide you. Would you agree, Rebecca?
Yeah, I would say that the conversations that I have are typically unless a client comes in knowing we're talking about charitable giving and they're like, I definitely want to give to XYZ charity. The way I typically do it is I kind of treat them the same way, probably maybe because I've been a fundraiser, so I do it because I know what I'm doing in that respect. But I ask them, like, what is it that you're trying to accomplish? Like, what are your goals? And, I will be frank, and I know this is going to probably offend some of the programmatic folks on the call, but I do typically refer them to the community foundation if they don't know what they are trying to accomplish, because I feel like they have good resources to help them think through those ideas. And then hopefully it ends up, being beneficial for other, programmatic charities too. But I think that it's kind of the same idea in my mind. It's like, I'm not telling them what to do because I'm an advisor, right? That's the whole job. I don't tell them what to do. I tell them what they can do, what is possible, and then let them decide. So Mark, I think you're exactly right. But I do think, there is, like what Brian was saying, if the advisor is at least familiar with your organization or they know the work that you're doing, it doesn't mean that they aren't going to make a suggestion, right? Like I may suggest, if the person says, I'm really concerned about the homeless population in Providence, and I might say, okay, well, I know of 3 organizations that are working on that. Why don't we delve more into that and see if that's a good fit for you or not? So I think that, advisors are out there trying to do this, but again, you're trying to balance always the whole picture against this one particular faction. So that's where I think it can be challenging for us to do. So,
Rebecca,
yeah,
I don't want to be
but yeah.
redundant, but I do want to emphasize what you said because it's very important about trying to stay in front of advisors. But what you're not going to get is a lot of face time for those people that are charging per hour.
Mhm.
Because keep in mind, when you're talking, they're giving up whatever it is their hourly rate to talk to you. But there's different ways to stay in front of them. And that is like, you should, I would try to schedule how many touches do you want to have in a year, whether that's 3 touches or 5 touches or 8 touches, whatever it might be. But send them something of value. And what you think may not be of value, but if you could send them an article you read in the paper about, it could be a current article about a family that was just feuding, and they had talked to you about, they were worried about their children feuding. Or if there was an article about how to use a donor advised fund effectively, how somebody did that. Or if there was an article about a family who made an inspirational gift, or whatever it might be, you can send them, if it's something they can just forward to their client with a note, thought you'd find of interest. So now the advisor sees it coming from you. They spent 10 seconds on it, put a note on it, sent to their client. You've helped that advisor look good to their clients. So that's the kind of stuff. You don't need to send them tax treaties on the intricacies of Trevor Remainder Trust. You're not going to educate them that way. But how do you make them look good that they can help their clients? So don't underestimate doing that.
Yeah, and I think sometimes you also have to think about going to where they are too. So there are lots of organizations there's always a local like CPA chapter. There's lots of, bar events. There's sub events within all of these groups. Financial planners have their own events. And frankly, they're looking sometimes for content. So they may want, you to talk about your charity. I know I work with a bar association group here, and we highlight several charities throughout the year at our events and in our newsletters. So there's ways to kind of go where they are. And, sometimes they have open events for the public. And if you can get on their lists and attend their events, you can meet lots of people, and they're already, there and having a good time and talking to their friends and maybe having a glass of wine or something. So like, it's easy to have the conversation with them. So don't, like, see if you can find a way. And I think one way to do that is having some folks in in your network, whether it's on your board or in your advisory group, who can get you connected into those other larger groups too. So, I would say that's one kind of easier way to get in front of a bunch of advisors and be ready to talk to them about what it is that you're doing. And again, how can you help them help educate their clients? I think that's kind of the piece of this that we're trying to emphasize. So I don't know, Mark, if you had something else you wanted to say about that, but I can go. I think the next slide is kind of along that same line and sort of a little bit about what we've already been discussing. It's the concept of being an expert. So like, you may not have, a robust knowledge of how the tax code works with respect to, business interest gifts or something like that. You don't have to be that person. You have to know who those people are who can help you. So people like, Charitable Solutions, or if you know people through your community foundation or, AFP chapter, whoever it is who can help you with that. But you want to, educate yourself. There's a bunch of free webinars that Brian mentioned that are on the website in all different topics that you can watch. Obviously, we talked a little bit about the Chartered Advisors in Philanthropy program. Sorry for not spelling that out. I just realized I did that twice. It's a occupational hazard. But programs like that are helpful. Your local AFP, Plan Giving Council chapters, again, are helpful. And then the more that you know, again, they're going to be looking for content, and maybe you can be a speaker and again, get yourself out in front of your own community as an expert. So Mark, I don't know if you have other resources that you think are useful that I didn't put on the slide.
Well, I just ran into this one actually earlier this week or last week, I guess it was a program offered by this is to community foundations by a group called Embolden. And they have I think it's a 6-week, 1 hour a week webinar program on how to work with professional advisors for community foundations. So I assume there's other type of programs out there, but to your point, that you should look into those. And then some people are scared to death. You're saying, well, you're asking these nonprofit people to develop a person, get up and talk to a group of lawyers or accountants, and that's intimidating at times. But you can partner with somebody else, or you bring in somebody else. I mean, I know Brian, I don't know what he said, talks 160 times or whatever it was, but crazy. But when you bring somebody in, you get to bask in their glow just a little bit. So you don't have to be the expert. Bring the expert in, but you're sponsoring them or partnering with them, or they defer to you for a small piece. So there's a lot of ways that you can still participate in providing this expert knowledge without you being the expert yourself at it.
Exactly. Yeah. And I think one thing I should have put on here too is your local community foundation. I know both of the ones I worked at had a robust nonprofit training program, particularly effective for the people who had nonprofits who had funds at the community foundation. Not that there was a quid pro quo. I'm not trying to imply that, but it does, sometimes it helps. But they do have a lot of trainings and resources available. So don't, make sure you're tapping into that as well. So I think we're just about at time.
Rebecca, I have one more thing. Brian asked me to remind, I would,
Oh, yeah.
I'm gonna put an unabashed blast promotion for my book, and it's called A Spectrum of Legacies. And the reason advisors and nonprofits are using this across the country is because it's short stories based on oftentimes people have made gifts and there are the questions that families are talking about is to make sure they have enough money for themselves. How much should I give my children? How am I going to be remembered? And on the website, it's all free about if people want to write letters to their children. Here's sample letters to the children. Here's the forms they should fill out before they see their financial advisor or their attorney or the accountant. And I see the websites at the bottom there, spectrumoflegacies.com. And so anyway, people are taking little chapters or pages out of the book and sending it to donors and said, thought you might find this of interest. It's just another resource that you can send out to make yourself look good and to have another touch with your donor. So there, I made my pitch.
No, that's great. Yeah, that's super helpful. I wanted to put that up too.
Exactly. We're going to make it stronger for you, Mark. So when we send out the link for this and the Q&A, we'll include a link, that you can get the book, et cetera, beyond just the website. So we'll include that as well. Here are all the past webinars. As Rebecca mentioned, we got 28 from 2020 to 2022 that are too many to jam on this piece. But one of those in particular I put in the chat was we did a whole thing around CAP designation specifically. So a whole webinar just on that, all the questions, different ways people are using the study groups and so on. That's August 2021. And the other quick thing I would say is there's a great question that sort of came in. I'm going to mush two. So our last couple of minutes, I'd like you guys to maybe comment on this. So I'm going to mush the two. It says, do you have any recommendation on navigating outreach to advisors when they're hearing from many other organizations in the area? And so since they won't make a specific recommendation on what nonprofit to support, but we want them to know about us and sort of endorsing us, sort of help facilitate a donor's giving. That's a lot there, but I want to sort of mush that with, so then if you're saying they don't generally direct donors, is there much ROI in even doing this? Is it worthwhile? So sort of those two things about, you know, what we'll say maybe non-community foundations, other charities, sort of what the ROI and positioning is.
Yeah, Mark, you can go first. That's fine.
Yeah, I mean, the trend has been undeniable that donors are used to go first to the nonprofit, and now they're going to advisors first. I mean, it's totally shifted the pendulum. I don't know what the number is now. 60 some or 70% of people are going to reach out to advisors first to make any significant gifts. So again, I'm not talking about somebody who's going to give you a $500 cash. I'm talking about somebody who's going to give you a $25,000, $50,000, $250,000 a gift of stock or real estate. Those are the type of gifts I'm talking about. And so you have to go through the advisor. You can either pretend they don't exist and you're going to get shot down by the advisor when he says why you can't do it, or you can work with the advisor and make them your friend, and they will partner with you and help in making the gift. So I don't think it's actually a choice. You just have to figure out how best to do it that fits your style.
Yeah, I think that's true. And I can appreciate the fact that, especially for smaller shops, it's hard to decide where to put your resources, right? You're trying to raise current gifts and maybe start a plan giving program and do all your events and all the things that you're trying to do. So it's hard to fit another thing in, but I think to Mark's point, it's really important. And I think it's like thinking about them as your donors. Like, you don't walk into your donor, prospective donor on your first meeting and say, hey, can you give us $100,000? We just met. Right, you're going to work up to some type of ask like that. You have several opportunities to meet with them and talk to them. But again, it doesn't have to be like recreating the wheel. If you're already doing a newsletter, just start sending it to advisors. If you're already holding events, just start inviting advisors. Like, don't try to build something from scratch. Do the things you're already doing and include the advisor. And then once you get maybe a couple people on your board and you see some people showing up to your events, those are the people you're going to start cultivating. And then from there, you grow it out. It's kind of the same way you would do a fundraising program, right? So do what you're doing, but just do it with advisors.
Exactly. I so appreciate, more than you guys know, Rebecca and Mark's very practical experience and advice. So things just like that. So thank you both very, very much for the content for this this month's webinar. Friend or foe, hopefully we'll be all friends or future friends. But this again will be sent out next week with the full recording. Those of the Q&A that we were not able to get to, we'll be able to get to all of those as well. We're going to mush that with the Thursday Q&A so that you'll have the benefit of that, as well as the instructions for Mark's book. So thank you guys very, very much. Everybody have a great day.
Thanks.
Welcome. Bye.